Hello guys, I have come again with a new video. In the previous few videos, we have talked about the payment fundamentals, the payment infrastructure, uh, MT messages, MX messages, clearing and settlement, payment rails, and domestic and cross-border payments. Today's topic will be actually specific to cross-border payments. Um, in cross-border payments, there is a very important player that comes to play a bigger role, and that particular player we know it as correspondent banking or correspondent banks. In simple words, when one bank cannot directly access uh, another country, another currency, or another clearing system, it uses another bank's network and account relationship. That other bank becomes a correspondent bank. In today's video, we will be talking all about correspondent banking and the things associated with it. For example, the Nostro, Vostro, Loro, and all. Before we go into definition, let's understand the bigger picture first. Cross-border payments need two things. One is instruction, and the other is settlement. Instruction means what should happen. Settlement means how value actually moves. For example, if a customer sends $1,000 to his supplier in the US, the payment instruction can be sent through either Swift or ISO 20022 messages. But that message alone does not magically create money in the beneficiary bank. Message sent is not exactly the same as funds automatically available. So the banks must have a route. Banks must have a route, a correspondent banking relationship, and sufficient account balance. If the account balance is not available, the message may be perfectly correct, but the payment may still get delayed. In simple words, the message is like sending a delivery instruction, and settlement is like actually having the goods and moving them to the receiver. Now that we know the big picture, let's define the correspondent banking clearly. So correspondent banking is a relationship. Okay, it's a relationship where one bank um, provides payment, cash management, settlement, and related services to another bank. The bank needing the service is called the respondent bank, and the bank providing those service is called the correspondent bank. So if I have to put it in simple terms, correspondent banking means one bank uses another bank's infrastructure or accounts to provide cross-border services. For example, suppose State Bank of India wants to send US dollar to a beneficiary in the US. So SBI may not have direct US clearing access. So it uses, for example, it uses Bank of America in New York. Bank of America provides the US dollar account and settlement support. And in this particular example, Bank of America is the correspondent bank. Now, you may have this question in mind that why this system exists. Why do we need correspondent banks? So this particular slide explains why correspondent banking exists. So a bank cannot have branches in every country. It may not be a direct member of every domestic clearing system. It may also not hold a settlement account in every currency. Then it may not have it may need foreign currency access, but customers still expect the banks to send and receive cross-border payments in a foreign currencies. So correspondent banking solves these problems. So correspondent banking basically solves this list of problems. So think of it like international roaming. So your mobile operator may not own towers in every country, but it partners with local networks so that your phone still works abroad. Similarly, banks use correspondent relationships to reach foreign markets. Now that we know why correspondent banks are needed, let's identify the parties in the chain. So, in correspondent banking, there are multiple parties involved. First is a respondent bank. First is a respondent bank. So this is the bank that needs the service. For example, a bank A in India, say for example SBI. Second is the correspondent bank. So this is the bank providing account and settlement support. Third is your intermediary bank. Sometimes the payment has to pass through one or more banks before reaching the beneficiary bank. In that case, intermediary bank comes to the picture. Fourth is the beneficiary bank. This is the final bank that credits the beneficiary customer, or this is the bank where the beneficiary customer has his or her account. So the longer this chain, the more chances of cost, delay, screening, repair, and investigation. Now coming to a very important concept of Nostro, Vostro, and Loro. So Nostro, Vostro, and Loro are not three different products. They are mostly about a perspective. Nostro means our account with you. Vostro means your account with us, and Loro simply means their account with them. And that's from a third party perspective. The same underlying account can be called Nostro can by one bank, can be called Vostro by other bank, and maybe Loro as well from by some other bank. Now let's try to make this very simple with an example. Say for example, we have a SDFC bank. We have a SDFC bank. SDFC this SDFC bank holds a USD account with JP Morgan. SDFC bank holds a USD account with JP Morgan. Now from SDFC's point of view, this USD account is a Nostro account. From JP Morgan's point of view, this account will be called Nostro account. That means our account with you. And from JP Morgan's point of view, this will be called Vostro account. That is your account with us. Now suppose ICICI Bank is looking at this relationship between SDFC and JP Morgan. ICICI is not the owner of any of this account, and ICICI is not also maintaining the account. Now, from ICICI's third party point of view, ICICI will say that is SDFC that is SDFC's account with JP Morgan, or ICICI Bank will say it's a Loro account, that is their account with them. So that's how this Nostro, Vostro, and Loro account basically um, look like. So many beginners get confused because they think Nostro and Vostro are two separate accounts. Usually, they are the same account seen from different perspectives or different sides. Now, let's see why the balance in that account matters so much. Why the balance in Nostro account matters so much. Um, this slide explains a very important operational activity actually. So a payment instruction may be ready, the Swift message may be valid, the ISO 20022 message may pass all the validations, but if Nostro account does not have sufficient balance, settlement can be delayed. That is why Treasury and payment operations team are closely connected. In simple words, a message sent does not mean your does not mean money is available. So imagine you book a cab, and you book a cab and send a destination to a driver. But if there is no fuel in the car, the journey will not start. Similarly, the bank may have a correct instruction, but without Nostro liquidity, settlement may not happen on time. So if a payment is stuck, always try to ask if the Nostro account is funded or not in case of cross-border transaction. Now let's see how correspondent relationship can be direct or indirect. So a direct correspondent relationship means bank A has a direct or service relationship with bank B. This is usually faster, cheaper, and simpler as well. And an indirect uh, relationship means bank A needs to go through multiple banks like bank B, bank C to reach the beneficiary bank D. The more the banks in this chain, the more complexity increases. So there will be extra fees, extra screening, extra more repair points, and more investigation complexity. So think of this as a traveling. Um, a direct flight is simpler, and a journey with three connecting flights can still work, but there are more chances of delay, baggage issues, and confusion. That's how we can basically simply understand the concept of direct and indirect correspondent relationship. Now let us move to one of the most important advanced topics, that is serial and cover payment. So these are two important models: serial payment and cover payment. In a serial payment, the payment instruction moves from bank to bank along the chain. For example, bank A sends to bank B, bank B sends to bank C, and so on until the beneficiary bank credits the customer. In cover payment, the customer instruction and final settlement leg are separated. In simple words, serial payment is serial payment is one chain, that where instruction moves bank by bank, and in case of cover, um instruction and funds move separately. In empty language, MT103 is the MT103 is the customer payment instruction, and MT202 cover is the uh, is the cover or funds leg, or the corresponding leg. And in ISO 2002, PEX .008 is the customer credit transfer leg, and PEX .009 cover relates to the cover or FI funds leg in the relevant scenarios. Many beginners might think like serial and cover payment is just a message format choice. They are not actually. It's a settlement design choice. Okay. Now let's zoom into the serial payment flow first. So in serial flow, the payment moves bank by bank, as we have already seen in the previous slide. The sender bank creates the payment instruction. Intermediate bank receives it. Um, Intermediate bank does the validation, screens it, applies routing and charges, and then forwards it to the intermediate bank 2. Intermediate bank 2 will do the same, and finally the beneficiary bank receives it and credits the beneficiary customer. Um, each bank may screen the payment for validation, apply charges, repair missing data, or even hold the payment if something looks suspicious. That is why, in serial payment, a payment can be delayed even after it leaves the sender bank. It may be sitting at intermediary bank one, or it may sit within intermediary bank two, or maybe if there is some more intermediary bank, it may sit there as well. That's why the payment get delayed. Now let's compare this with the cover payment, where the instruction and funds leg separate. In a cover payment, we have two different legs. There are two legs. One is the instruction leg, and one is the funding leg. So in instruction leg, bank A will send the custom payment instruction towards the beneficiary side. So in empty terms, this is typically MT103, and in MX term, this is typically PEX.008. In the cover or funds leg, bank A or its correspondent sends the fund settlement instruction through the correspondent chain. So in empty terms, this is MT202 cover, and in MX term, this is PEX.009 cover. The beneficiary side applies the credit. The beneficiary side applies the credit when the required business conditions are satisfied. So one message will tell the beneficiary side what to credit, and the other message coming through the other leg helps settle the funds. Just imagine ordering food online. So one instruction goes to the restaurant, prepare this order, and another process handles the payment settlement. So both are related, but they are not the same thing. Now let's see how settlement actually happens between these messages. So correspondent banking settlement usually happens through balance adjustment in the interbank accounts. Balance adjustment in the interbank accounts. So bank A will send an instruction. Bank A will send an instruction. The correspondent account is debited. The correspondent account is debited or credited. The next bank receives the value. Finally, the beneficiary bank credits the customer. The important point is that money is not physically moving in any suitcase across the border. It is usually account balance adjustment between the banks. As you can see, this accounting entries. Settlement is actually accounting movement across bank relationships. For example, if bank A's Nostro account with bank B is debited, bank B can provide value onward according to the payment route. Now let's understand what affects the final customer outcome. There's the foreign exchange fees and the compliance impact. Correspondent banking affects the final amount received by the beneficiary. First is due to the foreign exchange impact. So if currency conversion is required, exchange rate, spreads, and value dates will come to picture. Second is the fees and charges. The beneficiary may receive less because of different charging model, or because of intermediate deductions, correspondent fees, or local receiving bank charges as well. Third is the compliance checkpoints. So each intermediate bank may screen the payment. If there is a sanctions hit, missing beneficiary data, poor ordering customer data, or repair request, the payment may stop. So when a customer asks, why did the beneficiary receive less? Possible reasons include your intermediate deduction, correspondent fee, then bank charge. And when a customer asks, why did the payment stop? Possible reasons include your sanction screening, missing data, repair request, or intermediary hold. Now let's see some common issues and misunderstanding. Okay, so there are four important flows to not exactly flows. Let's look at this common issues and misunderstanding. Most problems fall into a few predictable buckets. First is the conceptual misunderstanding. So people may think Swift and correspondent banking are the same, or that Nostro and Vostro accounts are different physical accounts, or that messes dispatch guarantees funding. Second is Nostro issues. This include insufficient balance, wrong value date, funding delay, mismatch with expected debit or credit, or unreconciled entries. Third is the routing issues. So wrong intermediary, suboptimal path, too many too many intermediaries, unsupported corridor, or wrong serial cover configuration may also lead to the routing issues. Then the fourth is fee or investigation issues. Bank beneficiary received less charge code mismatch, intermediary hold, sanctions repair, missing the tower, unclear fund location. A delayed payment may be, you know, a messaging issue, a liquidity issue, compliance issue, charge issue, routing issue, or posting issue. So overall, these are some common issues or misunderstanding that we frequently face or frequently encounter in our correspondent banking kind of context. And with this, we come to the end of this module. In today's video, we learned that correspondent banking is the backbone of many cross-border payments. It helps banks reach foreign markets and currencies through account relationships with other banks. We understood that Nostro and Vostro are perspective-based terms, not completely different physical accounts. We also saw why Nostro liquidity matters, why serial and cover payments are different, and why charges, foreign exchange, compliance, and reconciliation can affect the final customer outcome. If this video has helped you understand correspondent banking, Nostro, Vostro, Loro accounts, please do like the video, subscribe to the channel, and share it with your friends or anyone learning payments or banking domain. Thank you for watching. I will see you in the next session.